All right, we had a sharp sell-off in equities, particularly on the TSX, but in the U.S. as well. Our next guest is undaunted and says we still finish the year a little higher than where we are right now. John Stoltzfus is a managing director and chief investment strategist at Oppenheimer Asset Management. He joins us now. And John, when we talked to you at the beginning of the year, your target of 5,500 looked so wildly bullish. And then here we are now, just 4% away from that. You still confident we're going to get there?
Yeah, well, Amber, thanks for having me on the show. And have to say, we most certainly remain confident that there's an excellent opportunity to get to that 5,500 by the end of the year for the S&P 500, perhaps sooner, and we might even close higher than that. We think the action today in the market is less of a sell-off. It's not even a haircut, more of a trim, if anything else, if we look at the percentages based on where the market has really run up from the beginning of the year or from last October.
Yeah, they can't all be up days. So I'm curious if you think the risk to your target price might actually be to the upside.
Yes, we do think they are to the upside. We still see resilience in business, resilience in the consumer, resilience in job creation. Innovation still a big driver here, and then need for people to invest in equities because the Social Security system in the U.S. has some challenges ahead. We think a lot of people, whether they're in retirement, about to go into retirement, or preparing years ahead, recognizing this, are wanting to invest for their future in retirement and thinking in order to retain a style of living that they've come to enjoy once they stop working. And that means you're going to get some higher prices in equities, higher prices in multiples, and likely, certainly some resistance to downdrafts when they occur. Notwithstanding downdrafts that naturally occur in markets, as from time to time we get haircuts like this.
Well, I mean, are you saying that the nature of the buyers out there looking at equities is different than any other point in history? I mean, haven't equities always been part of a strategy for those looking to retire and live off their assets?
I most certainly think that it has been for many years. Equities have been a portion of that. But we're actually seeing a greater percentage of individuals in the United States having exposure to equities. I don't recall where I saw it, but it was from vetted press like Bloomberg or the Wall Street Journal or Barron's. But it was mentioned that the percentage is fairly significant in terms of the increase. My recollection is the standard is about 48% of households have some kind of exposure to equities. Today, it's closer to 60%. Now, the thing about it is we've gone through a period where Social Security for years had problems that were envisioned up ahead, years and years ahead. Now Social Security, unless something is done, there are likely reduced benefits ahead for retirees when the time comes, or maybe even for people who are already collecting Social Security. It's still, unresolved issues. And so we think that people are, recognizing the need in many ways. So it's a market that usually on the trading side, it's greed and fear and excitement, a bit of a gamble, but when it comes to investing for a kid's education, for retirement, you're looking at need, and it becomes much more serious. Changes in retirement planning are significant in the U.S. Defined benefit pension plans have been on the wane now for over 20, 25 years. Most is, at best, is defined benefit. And people are really finding that they probably didn't save enough. So we think this may be a lot of people trying to catch up, and others, prudently, we believe, planning for the future.
Well, let's get back to kind of the market dynamics, because you are so bullish and you see, a little bit of more gains from here. Are you perturbed by this little whiff of caution that we seem to be seeing take hold in the market? And I'm not just talking about today, but defensive starting to do better, utilities starting to do better. Even, we just had earnings from Salesforce. like many other big tech companies, noting that they're seeing a slowdown from their customers. Sales cycles are elongating. Just a little bit of caution dabbled here and there.
Well, we'd have to say the interest in areas, for instance, in utilities, the Utes usually when interest rates, when the Fed is in an interest rate hike cycle, and when there's always a chance that if it's in a hike cycle that it might even raise another time, utilities are taken as a bond proxy, and so there's a tendency for them to weaken. This cycle, it looks like suddenly there's several things. One is, I think the market, at least on one side, has a certain sense that indeed the Fed is closer to an end to the Fed funds hike cycle and likely to cut probably in November or December, maybe both months after the election. On the other hand, utilities also, look attractive from a longer term perspective. We think it certainly is a longer duration idea, so we don't think it's exactly wise to pile into the utilities while gaining exposure at a more prudent level. The reality is it's the electric grid, and those regulated utilities are likely to play a big role in the development of a much more state-of-the-art grid than rather one that is nearly an anachronism that we have today in the United States in terms of the generation of electricity as well as the transportation of it, delivery of it.